Hi, this is Andy Filipiak in Toronto for the week of February the 20th. Last week, Fed Chairperson Janet Yellen went to Congress and indicated that a rate hike in March is still a possibility. This affected the markets quite dramatically, as it was built in all likelihood, that the Fed was not going to raise interest rates. Given that the U.S. economy grew at 1.6% in the year 2016, the Fed is raising rates not because of the strength of the economy, but to have rates high enough to fight the next recession. The Fed controls the amount of credit in the system through two means: interest rates and the Fed's balance sheet. It's important to keep everything in perspective, as currently the Fed funds rate's at half of 1%. In normal times, the Fed funds rate would be approximately 2% above the current inflation rate, which at a little over 2% means we should be at about 4.5% instead of 1/2. The other tool at the Fed's disposal is the use of its balance sheet. Since the beginning of quantitative easing, the Fed has taken the size of its balance sheet up from $800 million to currently about $4.5 trillion. This was achieved by the Fed printing money, buying treasuries and mortgage-backed securities. This printing of money put additional cash into the system, and the Fed moved the bonds and the mortgage backs that they bought onto their balance sheet. Yellen hinted that the Fed is getting closer to shrinking its balance sheet. Until then, any maturing bond or mortgage back, they will simply roll into a new product and keep the Fed's balance sheet the same size. It is highly unlikely that we will see any time in the near future the Fed shrinking its balance sheet, as this results in the immediate removal of cash from the system. And the last thing the Federal Reserve wants to do in a slow growth economy is to pull money from the system. This could lead to a sharp sell-off in most financial assets. I'll discuss this topic more in future broadcasts. Thanks for watching.